Good morning. This is Larry McMillan with a market update on Monday, February 8th, before the market opens. So last week, the S&P was up every day, recovered the entire set of losses from the week before, made the Jan seasonal pattern a winning trade once again. And in fact, it exactly duplicated what it did in 2020. The last day of January was down pretty big, and then in 4 days, the market moved to new all-time highs. Duplicating what happened in 2020 is not exactly a positive thing going forward. Hopefully that won't happen again, but who knows? In any case, the S&P is very strong now. It has support at 3,700, which was the lows of the last day of January, the day before actually, and then also at 3630. So as long as it's above those levels, its trend is still positive. And there's a couple of little gaps on the chart. It might pull back and fill those, but the chart is now once again strongly positive. The equity-only put-call ratios are somewhat split. The standard ratio continues to drop as call buying is heavy, especially of out-of-the-money, cheaper calls. And so the standard ratio is at its lowest point since 1999, which is amazing. And if you'll recall, of course, that was a very euphoric period at the end of the tech boom there. But it still went on for a while. I mean, the tech boom probably didn't end until April of 2000 on that sort of tech wreck day. So while it's overbought, it's still on a buy signal. The weighted ratio had been kind of edging higher. Now even that is beginning to roll back down again. The reason that the two ratios are differing is that the weighted ratio measures dollars, so that the heavier dollars are being spent by more like institutions rolling out of long stock into long calls, whereas the standard ratio just measures volume. Breadth has been strong, and both breadth oscillators are on buy signals. Cumulative advanced decline lines are making new all-time highs, as is cumulative volume breadth. In fact, cumulative volume breadth has just been crazy. It's made an all-time high now on 19 of the last 23 trading days. So that measures the volume on advancing issues minus the volume on declining issues. And it's been very strong. VIX is representative of volatility, of course, and it's dropping sharply. It has since that, a week and a half ago. And it gave a spike peak buy signal on January 28th, and that's still in effect. In fact, it looks like VIX is going to finally try to go below 20 for the first time in over a year. We'll see if that actually happens, because the S&P traders have been still worried about things that are going on and have kept VIX at a pretty elevated level, even though realized volatility has come down quite a bit. The construct of VIX futures is also positive. They're trading at a premium to VIX, and the term structure slopes upward. So all in all, these indicators use that little pause there at the end of January to get back on the positive side, and everything is really quite bullish once again. But do not become complacent. But as we saw a year ago, the market moved to new highs in February. Everything looked pretty good. And then it collapsed badly on the coronavirus. So it would never be exactly the same, but there's always the danger when the market is this overbought that selling can snowball, because everybody decides to sell at once, just like right now, very few people are selling. So just be careful, roll your long calls up in positive, your long strikes up in positive long call positions. Raise your trailing stops on stocks, and otherwise visit our website, take a look at our newsletters, and enjoy the week trading.